Hey guys, and welcome back to another video here. Today we will be analyzing Lemonade stock, ticker symbol LMND. In today's video, I'm going to go through Lemonade's fundamentals, financials, business model, things like their balance sheet, and make sure to stick around till the very end of the video where I give my 5 to 10 year outlook on revenue and also buy targets on the stock. A brief overview here of Lemonade, currently trading at $63.50 per share at right around a $3.6 billion market cap. The stock IPO'd back in June, July of this year, shot up to around 90 bucks a share, and it's been on a bit of a downtrend ever since. Now, if you are new here, please make sure to subscribe and also hit that like button as it really helps the channel out. If you have any questions or ticker symbols that you want me to look at, make sure to drop those down below in the comment section and I'll get back to you soon. So Lemonade is essentially a company disrupting the insurance industry, which hasn't been changed in centuries. They are doing this through things such as artificial intelligence and a business model that hasn't really been seen before, to do things that no other insurance company has done. So here we have a nice overview of how Lemonade works as a business. Lemonade reverses the traditional insurance model. We treat the premiums you pay as if it's your money, not ours. With Lemonade, everything becomes simple and transparent. We take a flat fee, pay claims super fast, and give back what's left to causes you care about. This is entirely different from the normal insurance model. Lemonade essentially takes 25% of all premiums earned. So let's say you pay $1 in premiums for your insurance. Lemonade takes 25 cents of that for themselves. The other 75 cents are used to pay claims. And if there's any money left over from those 75 cents after all claims are paid, they just donate that to a charity of your choice. This is very different from the normal insurance business model, because the normal insurance business model creates a conflicting relationship between the insurance company and the individual. The insurance company is incentivized not to pay out claims, because the less claims they pay, the more they take in revenue. Lemonade just takes a 25% fee, 25% cut rather, and then everything else is used to pay claims, and if there's anything left over, they give that back to charity. Just a great different business model that creates a nice relationship between the insurance company and the individual using it. Now, this is very important to note what an insurance premium is. An insurance premium is the amount of money an individual or business must pay for an insurance policy. This is important. Insurance premium is not the amount of revenue that Lemonade recognizes. Lemonade recognizes that 25% cut as revenue. The other 75% they don't recognize as revenue, so it's important to know what the premium is versus the revenue and how to kind of differentiate the two. So here's an example of Lemonade using artificial intelligence to their advantage. Maya, our charming AI bot, will craft the perfect insurance for you. It couldn't be easier or faster. Look at this. 90 seconds to get insured and 3 minutes to get paid. Just incredible numbers. What insurance company pays out claims this quickly? Normally it could take days, it could take weeks, it could take months even. Lemonade, 90 seconds to get it and 3 minutes to get paid. Just incredible. And this kind of piggybacks off of that business model that they have, the non-conflicting relationship. They're allowed to pay things super fast because they don't really worry about making money from that 75%. They just take that 25% cut. This benefits Lemonade from a cost savings perspective because they're using artificial intelligence. They're using a bot instead of an actual worker. The bot also generates more data. While a normal person would generate about 50, 60 data points from an individual or a customer, this bot collects over 900 data points. So this AI continues to get smarter, and we can see this here with the gross loss ratio. If you don't know what a gross loss ratio is, it's pretty much what the insurance company has to pay back from what it's earned in premiums. So at this moment in time, let's say they earn $1 in premium, they have to pay 67 cents back in essentially claims. This has been decreasing over the past few years, ever since they were an actual company. Look at that, it used to be 166%. They had to pay $1.66 back in claims for every dollar that they received. That's not good, but I mean, you can just see, as more people continue to use Lemonade, as the bot continues to get smarter, gather more data, it continues to improve its ability to track down those high-risk individuals in terms of possible claims and just get smarter overall. This is a little higher than the industry standard, which is around 50%, but if this trend continues, we should see that number in no time, and honestly, Lemonade eventually, in my opinion, will become a company with the lowest gross loss ratio, because again, artificial intelligence will just continue to get smarter and smarter and just outpace humans in the long run. Now, Lemonade currently only offers 3 different types of insurance: renter's insurance, homeowner's insurance, and pet insurance. They are expanding into different categories. I mean, they just released pet insurance around earlier of 2020. And again, I personally believe that they're just going to continue to expand into different segments of the insurance market. I do think auto insurance will be one of the major kind of growth drivers for them in the future, and also expanding into different countries. Currently, they're only available in around half or a majority of the states in the US and also in the UK. They are expanding into France later this year. They have mentioned that that is their priority. Global is really what they're aiming at in the long run here. And what they're kind of doing with only providing these 3 insurance plans, you can kind of see their goal here. Like, they're targeting millennials. That's their main group that they're targeting. And what they're kind of doing, they're capturing these millennials at a young age. And 95% of them, over 95% of them, have said that they're not going to switch from Lemonade. So their goal is to capture these millennials at a very young age, when they're still renters. And as they progress through life, as they go from being renters to condo owners to homeowners, they start to get more insurance, more different insurance plans, and more expensive insurance plans. They go from regular renter's insurance to condo insurance to homeowner's insurance. They get travel insurance, pet insurance, auto insurance, life insurance, and then the umbrella, which really captures all of it. Again, this is very smart. They're capturing people at a young age and really progressing with them throughout life. Now, Lemonade's customers here, there is not a lot of data. I have looked far and wide to find as much data as possible. They are a newly IPO'd company which hasn't released a lot of data yet, but this gives you a good picture of their growth in terms of customers. In Q1 of 2019, it was sitting under 400,000. Then in Q2 of 2019, it grew to 450,000. Then Q1 of this year, it was around 720,000. Then in Q2 of 2020, it went to over 800,000. So it was growing by a pretty substantial margin each time and really growing exponentially. Now, in terms of Lemonade's revenue, they are a small company despite that giant market cap. We'll talk about valuation in a bit here. But in Q1 of 2019, it was sitting above 10 million. Then in Q2 of 2019, it was around 14 million. Then in Q1 of 2020, it was around 27 million, and then Q2 of 2020, it's around 30 million. So definitely a very quickly growing company. They've pretty much managed to double their revenue within 1 year. I expect this to be a company growing revenues by a substantial amount for the next 5-10 years as they continue to expand to different insurance segments and to different countries worldwide. So here we have Lemonade's operating expenses, and you can see a majority of which goes to social and marketing. This, in my opinion, although it is costing Lemonade a lot of money, it totally makes sense. They're trying to get the word out to as many people as possible, and you can kind of think about it like a long-term investment, because 95% of individuals who are on Lemonade at this moment in time say they're never going to switch. So by acquiring customers right now, it's really difficult to comprehend how much money they're spending on a customer now versus how much money they're going to bring over the next 10, 20, 30, 40, 50 years to Lemonade. Now, Lemonade is going to be doing like a restructure of their revenue, just something to note for future quarters. As you look at their quarterly reports, their earnings, their revenue, it is going to look a little lower, although nothing's going to change with the business. It's just going to lower their revenue and increase their gross margins. So just something to note there when you're looking at future reports. So here we have Lemonade's balance sheet. We can see that they've got around $250 million in cash and cash equivalents. Now, this is mainly what you want to look at. They don't separate current assets versus long-term assets. So again, $260 million that they have at their disposal at this moment in time. Their liabilities currently lie at around $127 million in terms of current liabilities. It is a little weird to comprehend though, because it's policy liabilities, which is essentially money they owe in like claims that they have to pay, which I'm not sure why that's on the balance sheet. That's just something that that's what their business really relies on. They earn premiums and they have to pay those premiums back in claims. So they just kind of put that on the balance sheet. But I think this balance sheet is fine at this moment in time. There's nothing really to worry about. So here we have Lemonade's analyst expectations. They're expecting Lemonade to grow by 20% next year. This, in my opinion, from what I'm thinking, is after that revenue restructure. That's the only thing that makes sense, because they just grew their business by 100% over the past year. So it wouldn't make sense for them to only grow by 20% next year. That would be a little worrying, but in terms of accounting for that different revenue switch, that would make sense that they're growing by 20%. The fact that they're even growing at all with that giant revenue decrease is a good thing. Now, in terms of valuation, Lemonade is a $3.6 billion company losing money. The price to sales is at 36.3, which is probably one of the most expensive stocks I've ever seen, aside from Cloudflare and CrowdStrike. At a 36 price to sales, this is valued like a tech company. There's no doubt about that. And it is essentially pricing in success for Lemonade. So once we do the math here for my 5 to 10 year revenue expectations, I'm going to assume that Lemonade can succeed as a company. Because that's pretty much what you're betting on with Lemonade. They're going to succeed over the next 5 to 10 years and become a well-established, known name like Geico or State Farm. So when valuing a growth company, when valuing a high growth company, you have to really think about the TAM. And what that is the total addressable market. You have to consider, all right, how big is the total addressable market for Lemonade in the future? Where's the market cap now? And then how big of an upside is there from the two? The US insurance industry net premiums written totals $1.32 trillion in 2019. With that, we can make a few projections. And I'm going to make a few assumptions here. We are assuming that Lemonade does succeed as an insurance company in the future, which is what you're betting on if you do buy the stock. Lemonade has a 5% market share. No insurance company has over a 5% market share in the insurance industry. I think Lemonade could fit right in with that. That might honestly be conservative. If they do succeed, I think that number could actually be higher, just because of how incredible this business model is, how they're actually giving money to charity instead of taking it to themselves. The insurance industry continues to grow at 3% per year. That's what it's been growing at for the past little while, so we're just going to assume it grows like that for the next 10 years. 25% of premium is recognized as revenue, which Lemonade has been doing, so we're just going to assume that it continues to do that. Now, with that, we can assume that Lemonade is going to have $24.25 billion in revenue by 2030. Keep in mind, this is a long-term investment. This is a stock where you really have to hold it for the next 5 to 10 years just because of how lofty the valuation is at this moment in time. So we're looking at 2030 numbers just because of how long-term this company is. Now, if we're assuming around a 30% net profit from that revenue, which we can do. They are a tech company. They are going to be using artificial intelligence instead of workers, so costs related to that are going to be very low. Now, 30%, I think that honestly might be conservative. I think that honestly it could get closer to 40%, but we're going to just assume 30% net profit in the future, which would equal $7.275 billion in profit. Now, keep in mind, Lemonade's valuation at this moment in time, it's a little over $3 billion. They're expected to make, or by my calculations, they're expected to make $7.275 billion in profit by 2030. I know that is far away. Assuming that, it would not be unreasonable for Lemonade to be trading at a multi-hundred billion dollar market cap. Just judging, you could take maybe a price to earnings of 10, 15, maybe 20. Keep in mind, I think Lemonade's going to be valued like a tech company for its entire existence, just because of how techy it is, using artificial intelligence, the new business model. It is an insurance company, but it's an insurance company that heavily relies on technology. So assuming that Lemonade, $100+ billion market cap by 2030, which would be pretty much a 30x, over a 30x by 2030. And keep in mind, this is only considering the US industry. What about the European industry? What about the Canadian industry? What about the Asian industry? Keep that in mind. That is just a cherry on top. I'm just calculating the US insurance industry. So if they manage to succeed in Europe, in Canada, in Asia, this could get very, very interesting, needless to say. Now here are my buy targets for the stock, for Lemonade rather. Now, one thing to note, big dilution is coming in November to January of this year. They're releasing a lot of shares. The stock could easily drop 10, 20, 30, 40%. So that is a little worrisome. So I'm not going to be buying until after that dilution ends. Now, Lemonade, it is a 10-year hold. It is a very long-term hold, in my opinion. At this valuation is not justified whatsoever if you look at current metrics. You need to look at metrics 5, 6, 7, 8, 10 years down the road. So that being said, this may just be one of those stocks that I may have to buy, put it in the filing cabinet, and just leave it there. But if I'm going to be picky, this is picky. At $50 a share, I think that's good. Under 40, I think that's great. This is my opinion. Please do your own research. Please make up your own buy targets. But this is kind of what I'm thinking in terms of Lemonade for me. Please leave your thoughts on this in the comment section down below. And I hope you all have a great day.